Statcan just released our GDP numbers for February, and it looks like economic growth is continuing to stay low as unemployment continues to rise. However, many realtors in news articles and on social media have been saying we're kicking off a hot spring market, and they could be right, as long as you ignore all the data or any indicators used to differentiate a hot market from a cold one. However, in an actual physical sense, the spring housing market is technically heating up on account of how winter is mostly over now. That's right, folks, it's time for another Friday, or possibly Saturday, update with your old pal MillennialMoron. By the way, sorry this one is a week late, but I was having some trouble figuring out exactly how I wanted to write and present it because the stories are all kind of big and interconnected, which always makes me want to branch off in a bunch of different directions. Also, I've been traveling for work this whole time. I'm not even in my regular recording space right now, I'm in a hotel room. But unfortunately for the real estate industry, I am an unstoppable force of nature. Like a hurricane. Or a really big truck. With things happening faster and faster these days, I might start to look at a different format where I discuss one big topic at a time so I can get more into the history and context of each thing, but for today we'll stick with the classic formula. But first, a lot of people have been asking me to make merch for a long time, so I finally did. I made this friendship bracelet that says www.MillennialMoron.cow. Obviously it was supposed to say com instead of cow, but I ran out of M beads, so I put cow instead. But if you want, you can just flip this W upside down, and now it looks like it says com, so that's not bad. Also it has a skull on it, which is pretty cool. Anyway, this is a unique and handcrafted item, and there's only one in existence, and the price for that is $1,249, and that is in US dollars, so if you're thinking of buying it, just be aware of the exchange rate. So first up, we've got this story from the Globe and Mail saying that most Canadians with mortgages are about to see their payments soar. Looks like the Globe and Mail is finally catching up to the guy making videos in his basement. The article states that most of the pain is coming in the next 2 years, with 45% of all mortgages set to renew. Now, as an aside here, as much as I position myself as a housing doomer sort of person, this is a good example of why you should think about numbers in context instead of just accepting how they're portrayed. In the article, they phrase this in a way that makes it sound like an unusually large wave of mortgages are coming up for renewal in the next 2 years. It's almost half of all outstanding mortgages, so it does sound like a lot, but think about it for a second. The most common length of a mortgage term in Canada is 5 years, with anything longer than that being fairly rare. That means that on average, 20% of those mortgages will come up for renewal every year, so over 2 years, you'd expect about 40%. However, we've also got some shorter mortgage terms in the mix, like 1 and 3 year mortgages, which will push that number up a bit. So 45% is probably close to the expected value, meaning it's not an unusually large number at all. What does make this unusual is that there's still about 200 basis points, or 2 full percentage points, of spread between the interest rate charged on existing mortgages and the rates offered for new lending, which means that for the first time in decades, we're going to see almost everyone renewing at significantly higher rates instead of lower rates. Keep in mind, this average for existing mortgages includes people who have renewed already. A lot of the people renewing in the next 2 years are going to be people who borrowed when rates were at their absolute lowest, with fixed rate mortgages available at 2% or less. Those people could be renewing at rates 2 to 3 times as high as what they were expecting when they bought. As I've said before, this spread between the rates on existing lending versus new lending is an important factor that creates a lag time between rising rates and the impact on home prices. Until these two lines touch, we won't really know how big the impact actually is. Unfortunately for people renewing their mortgages, it doesn't look like that will happen anytime soon because markets are still expecting rates to stay higher for longer. The 5-year Canada bond yield has been steadily increasing since the start of the year, and while our existing lending rates still trail new lending rates by 200 basis points, the BAX market is currently only expecting 100 basis points in cuts by the end of next year. Next, Statcan released the GDP numbers for February, and our GDP increased by 0.2%, with the overall growth from last year being 2.5%. That number isn't particularly good or bad on its own, but keep in mind that over the last year, our population has grown by 3.2%, which means that although we still haven't met the technical definition of a recession, which is 2 consecutive quarters of negative GDP growth, these February numbers mean that our per-capita GDP is on track to decline again for the 7th quarter in a row. Overall, these numbers are a little worse than expected, and coupled with our unemployment data, which by the way shows Canada's unemployment growing at a rate significantly faster than our peer countries, is raising expectations of a rate cut from the Bank of Canada in June. Now, despite all this economic data, I'm still seeing a lot of articles from the real estate industry and posts from real estate professionals on social media saying that we're poised for a hot spring market as soon as rates come down, particularly in cities like Toronto. However, none of this seems to be backed up by the actual data from the market. In the latest data from Toronto, listings are up 74.4% from April of last year, but sales declined by 5% as the home price index continues to decline, down 1% year over year before accounting for inflation, although the benchmark price was up month over month from March. 2023 was already the worst year for sales since 2000, so a year-over-year decline in April doesn't exactly signal a hot spring market, especially with way more listings coming onto the market. Rob Marsiglio, a realtor in Toronto who posts a lot of really good data analysis on the Toronto market, made this chart showing that while new listings are continuing to trend upward, sales are staying flat, likely indicating that sellers are getting more motivated to unload their real estate assets than buyers are to acquire them. Also, he was recently misquoted in a BlogTO article about his data analysis in which they did not attempt to contact him for comment. Congrats, Rob, you've finally made it to the big leagues. Now, when interest rates were rising, one of the main talking points from the industry was that prices could never fall due to Canada's high immigration numbers, and even with interest rates being higher, prices would continue to rise due to population growth. But the problem with this assertion is that even though our population increased by 1.27 million people last year, prices were more or less stagnant, and real home values declined when you account for inflation. So now that the price spike from immigration has failed to materialize, the next idea they're pitching is that prices will start shooting up as soon as the first rate cut happens, so you need to buy now before interest rates fall. The problem is, of course, that rate cuts don't happen at random. They generally happen in response to a faltering economy and rising unemployment. So when rate cuts finally start happening, people might have even less money to use for housing. The realtor theory seems to be that there's a huge number of buyers waiting on the sidelines, and as soon as interest rates drop even a teeny bit, they're all going to pile in at once and drive prices up again. But apart from the weak economy and rising unemployment, as I mentioned earlier, we haven't even felt the full effects of the rate hikes yet. We're going to have more and more people over the next couple of years renewing their mortgages at much higher rates, which will drain even more money out of the economy. But on top of that, one of the major sources of leverage for borrowing more money on mortgages was using existing home equity. And since the peak in 2022, Canadian households have lost $744 billion in real estate value, while mortgage balances have increased by $183 billion, so overall we've lost about $927 billion in net equity tied to real estate. That means a lot less collateral to borrow against. And for investors who are funding their down payments through home equity, our bank regulator, OSFI, just reduced the amount you can borrow against your home from 80% to 65%. So people who've been relying on borrowing against home equity to expand their real estate portfolio won't be able to borrow more, or might even need to start paying money back, especially because prices have declined at the same time. At the overall household level, we've seen the cost of living rising rapidly, which has resulted in a reduction in household savings. In fact, the bottom 60% of households in Canada have negative savings, meaning that they're spending more than they're bringing in. Like I said, we hear a lot of talk about how demand is outpacing supply for housing because of population growth, so prices have to rise. And yes, over the past 3 years, our population has grown by about 7.1%, which is a very fast increase. But here's the thing I've been trying to explain. While the supply and demand of the real asset, in this case housing, is obviously always important, there's also a monetary side to supply and demand, and money has been getting a lot more expensive. Over the past 3 years, while our population went up by 7%, the cost to borrow money for a mortgage has roughly tripled since interest rates bottomed out in 2021. People renewing over the next couple of years who got in at extremely low rates may be seeing their interest payments increase by 100% or more. The Bank of Canada has also been engaging in quantitative tightening to undo the quantitative easing they did in 2020, pulling out about $265 billion in free cash from the economy so far. If you look at our money supply aggregates, this quantitative tightening combined with the increase in lending rates has actually created the largest and longest reduction in the money supply on record, and the data goes back almost 50 years. So I guess my question for the realtors is, if housing prices are about to shoot up, where does that money come from? It doesn't seem like anyone has enough money to buy at current prices, so how are they going to buy at higher prices later when they have less money to spend? Call me crazy, but I don't see a quarter-point rate cut suddenly solving all of these issues. Finally, we've had some talk from the federal government about the housing crisis and its origins, with Justin Trudeau recently responding to a question about home prices in Hamilton.
Hi, Prime Minister. Al Sweeney from CHCH here in Hamilton. If we could go back to the housing crisis that we're in now, just sort of as an overview, I wanted to run this past you. In 2015, when you became Prime Minister, the average house in Hamilton was about $334,000. 2024, it's $850,000, beyond the reach of many people. What happened? How did governments let this happen?
Boy, we could talk about the global economy, the inflation crisis that came from the fact that we had a once-in-a-century pandemic that had a huge impact on all of our lives. We could talk about the labor shortages that we're facing that continue to mean we need to grow our population. We're to continue to talk about inflation crisis around the world that has led to higher interest rates that have slowed things down. We can talk about the fact that Canada has only about 4% affordable housing stock across the country, whereas comparable countries like France or the UK have in the range of 17 or 18% affordable housing. Decisions taken by governments of all stripes over decades have led to this moment. There's something wrong with the way the system is built. The question people should ask themselves is, who's going to fix that system? Who has a plan to actually fix that system?
Now, the interesting thing about that answer is that, apart from the labor shortage stuff, pretty much everything he said is more or less correct. It's a problem with many contributing factors that has been added to by many governments over the past few decades. However, ending by asking who is going to solve the housing crisis is kind of a strange move. Now, Justin Trudeau may not be aware of this, but I looked into it and he's actually been the Prime Minister for like 8.5 years now. In fact, all the way back in 2015, their election platform promised to take action on housing affordability because it was already an obvious problem even back then. But even though they had a majority government for 4 years, they basically ignored most of the action items in their proposed plan. In fact, a number of the items they're pitching now are just recycled ideas from the 2015 platform that they never implemented. To me, the fact that they didn't do any of this stuff while they had the chance and just waited for the situation to keep getting worse makes me think they don't really have much interest in solving the housing crisis. It seems more like they want other people to think they want to solve the housing crisis, but they don't want to actually follow through and do it. And to be fair to the Liberals, we've all done that sort of thing before. Hey, so it's us, the people who live in Canada. Were you thinking of solving the housing crisis anytime soon? Oh my god, yes! I've been wanting to so bad, but I've just been like so crazy busy these days. I mean, work has just been nuts, obviously, and the kids are getting that age where, they're into so many activities and sports, and I feel like I'm spending all of my free time driving them around, you know? You know what it's like. But yeah, no, yeah, totally. We should get together sometime soon and solve the housing crisis. They're not going to call you, bro. Brunch is canceled. So it doesn't seem like either the Liberals or Conservatives are actually interested in a solution to the housing crisis. And while the NDP plan has ambitious targets and seems well-meaning at the surface level, there's almost no details on implementation. But a question I get asked a lot in DMs, and you may be wondering yourself, is which federal party would actually solve the housing crisis if they were elected? Anyway, that's all for this week, so as always, thanks for watching and enjoy your weekend.